It's Monday, and we're talking about where you can get back to work finding opportunities for your money.
Munis have underperformed year to date, primarily, intermediate to longer term munis. There's been a tremendous amount of supply. You had some volatility associated with the tax bill and the potential that the muni exemption was going to go away. But right now, if you look at valuations, long munis are close to 100% of the yield on treasuries. And historically, that's been a pretty good time to buy. So again, our theme would be absolute yields look pretty attractive. You're actually getting a real return relative to where inflation is currently. And if you look at that relative to other asset classes, things look pretty compelling.
That's Lyle Fitterer, Senior Portfolio Manager for Baird, where he runs two of the Baird's municipal bond funds. He's our big interview. But first, we talk with Selma Hepp, Chief Economist at Cotality, Chairperson of the National Association for Business Economics Business Conditions Survey. That's released this morning, and she's here to talk about what the economists see happening next. Plus, we go to the danger zone for a stock that is a leader in its field, but a laggard on the books. Kyle Gusky is here to discuss that. And then we talk stocks in the market call with Patrick Healy from Caliber Financial Partners.
Shut up and start talking.
I've got some time to do just that because this is Money Life for July the 28th. Thank you so much for joining me. My name is Chuck Jaffe, and I am your host here. And yeah, we've got a jam-packed show. We've been doing more shows where we only do 3 interviews, not because I don't like doing 4. I love doing 4, just because we've been letting our interviews run. And we do a little bit of that today, so we're going to keep the intro very short. But I will point out this is going to be a particularly interesting week because we've got a U.S.-European Union trade deal now. We are expecting more potential trade deals because we're basically waiting for the start of August. But we also have a lot of worries about there's this stock market euphoria, and euphoria is not too good, like it's a bad thing. So as much as we don't want to fight the market getting to record highs, there's a lot of sentiment out there suggesting that it's not a great thing that it is record highs. But you can expect the market to open pretty well because you got stock futures rising after the European Union trade deal. And oh, by the way, along with everything else, got a Fed meeting coming up. So you've got a little bit of anticipation there as well, though I don't think the Fed's going to do anything. But I've been wrong before. I did give my opinion on why I didn't think the Fed was going to do anything, not just now, but I actually am still thinking the Fed's going to be hard-pressed to do anything this year. That could change with any of the data that comes out because the Fed has said they're data dependent. But I gave that opinion on the Bull of Wall Street podcast. So Tally Leger from WCG Wealth Consulting Group, who's been a guest on the show multiple times and actually had been on the show from his previous employer, so we've known each other for a long time. Tally invited me on to their show where you get to hear me on the other end of the questions. If you want to find it, well, follow me on LinkedIn because we have a link there, but I'll try to also remember to put a link on our Money Life show page on Facebook, etc., because we're always trying to put stuff up there. There's a lot more content going out, a lot of promos, a lot of links to some articles that I have been writing, which are usually about things on the show. So if you want more content or more context, you can get it, but you're going to want to follow us on social media one way or another to do that. You can follow me on LinkedIn. You can follow the show on Facebook, on X, on Blue Sky, on Instagram, although Instagram, you don't get necessarily the articles because it's so driven by videos, but you'll get the promos at least. So whatever you want, get us there. And also, don't be shy about reaching out directly, chuck@moneylifeshow.com. We have a contest that we will resolve at the end of today's show, but right now, we better get busy. I've told you what's coming. Survey said, talking about economists kicks us off when the talk really starts next.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
We start this week's conversations talking about what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing, thinking, or feeling about when it comes to their money. And today it's not so much about their money because we are looking at the latest business conditions survey out from the National Association for Business Economics. It is nabe.com if you are looking for more information, details on the survey. But joining me now to discuss it, Selma Hepp. She is the chairperson for the Business Conditions Survey, but she's also chief economist at Cotality. Selma Hepp, it's great to have you back on Money Life.
Hi, Chuck. Thanks so much for having me back.
The good news here is that the economists see business conditions as steady. If there's bad news, they're not convinced that we're not having a recession. So even though I talk to a lot of folks who seem to think recession risk is down, the economists still seem to think recession risk is out there, even as things have gotten a little more stable, right?
Yeah, absolutely. I mean, in most current surveys, so this is the July survey data we're talking about, and the survey was conducted between July 2nd and July 11th, so pretty recently. And survey respondents were responding about business conditions over the second quarter. And as economists usually are, they are generally most concerned about a recession. So that's something that's on their mind all the time, and there's always slight possibility of recession in our minds as economists. But what's good about the most current survey is that the probabilities have gone down. About three-quarters of economists respondents in the previous survey thought that possibility of recession of being greater than 25%, so that 70% of them thought it was greater than 25%, and now we only have less than 60% thinking that probability is greater than 25%. So it's a significant shift in our mind, or significantly lower probability in our mind than it was before.
Yeah, the question that I have there is how frequent is it that economists change their mind that quickly? Because that's what I've seen in talking to people on my show as well, is that, as we got through Liberation Day, et cetera, the number of people saying, oh, my odds for recession have gone way up was huge. And then it backed off. And now it seems to be very low. So is the temperament change that we're seeing normal?
Well, no, but if you remember, going into our May survey, it was right after, or it was right during the Liberation Day negotiations, or, narrative. And so that raised concerns for potential recession for many, because they were worrying about supply chain disruptions. They were worried about reignition of inflation pressures, slowing of labor demand, and so everything else that goes into a recessionary economy. And as we've seen since then, not everything that was said during the Liberation Day it really got implemented. And a lot of these expectations on very high tariffs have actually been scaled back since.
I should point out to the audience the survey we're talking about was released today, this morning. As I look through the data, one of the things that I think is interesting is that we haven't seen dramatic changes in spite of all the headline risks about things like tariffs, et cetera. We haven't seen a massive drop off in people saying, oh, my profit margins are down, my company's profit margins have been cut. The question is, as we get towards August, where they're hoping that we're going to have final certainty and know where things are going, is there an expectation that the things that haven't shown up for tariffs, like some of the inflation and the rest, will show up once businesses go, okay, I've been eating this and letting this go along for a little while, but now that I know I'm going to change, like, is the big thing that we expect those conditions to show up in the third quarter?
Yeah, I mean, and that's where the wait and see approach is really reflected in what respondents say in this survey. Everybody's sort of still concerned about the of recessions. Again, we don't want to undermine that there is still that risk. And then there's still policy uncertainties. In the previous survey, about 60% of folks said they were worried about timing and implementation of current administration's policies. And the same share is still concerned about those implementation and timing of policies. That still could impact profit margins, that could still impact prices being charged, sales, and spending going forward. But as of the moment right now, we're all in sort of wait and see approach.
In terms of waiting and seeing on things like the Fed cutting rates, and this is not a survey that's really looking at those necessarily everything that you might expect out of the Fed, but is there a sense from the companies at this point and the economists at this point that rate cuts would significantly help in business conditions?
Yeah, actually, there is a question that asks what is the upside for the US economy? And avoiding U.S. recession obviously would be the most upside risk for the company's outlook. But the second highest is actually lower interest rates. So folks are working with expectation in mind that going forward, we are likely to see a lower interest rates, which would help their company's outlook and also economic outcome, lack of recession, I guess.
It was interesting to me, 69% of panelists put the probability of a recession at more than 25%. But how do we read that information? Because historically, the economy is in recession about 15% of the time. So if we got folks saying, yeah, there's like a 25% chance, that means there's not much of a chance. Like it's not that much beyond the most base cases, right?
Yeah, I would say so. I mean, when you ask an economist generally about recession, about half of them will say there is some probability of recession over the next 12 months. Half will say there is very little probability of the next 12 months. So, it's just really how this sentiment changes over time. And the fact that it has come down, it's a move in a positive direction for the expectations.
The percentage of respondents who said that materials costs at their firm have been on the rise. It's kind of unusual for that to be above 50%. It was above 50% in May. It is higher. It's at 56% now. Given that it was at 40% as we got to January, is that a sign that there are more tariff impacts that have started to hit?
Yeah, I think some sectors of the economy are experiencing, and my company is in a housing sector, and I've been following construction costs very closely, and you can see some of the impacts already in construction data, particularly for steel, for example, which was one of the first tariffs put in place. And one that hasn't changed a lot. So there's been more certainty around that tariff. And we are already starting to see it now being passed into the producer price index. On the flip side, for consumers, for example, cost of flooring has gone up, cost of appliances and windows has gone up, and that all goes into the construction of new homes. So we are already seeing some of these impact being passed through, not just to the producer prices, but also to consumer prices. And yes, that's what you can see in the results of this survey.
Selma, really interesting. I mean, there's a lot there. And of course, a lot of conditions changing all the time. So we're glad that we get the business condition survey. Thanks for joining me on Money Life to talk about it.
Thank you for having me, Chuck. It was a pleasure talking to you.
That's Selma Hepp. She is the chief economist at Cotality. And she's also the chairman of the NABE, the National Association for Business Economics Business Conditions Survey. NABE.com if you are looking for more information. And we're just getting started on the July 28th edition of Money Life. Up next, Lyle Fitterer from the Baird Funds will be here talking bonds. It's the big interview right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
It's time for the big interview on the July 28th edition of Money Life. Joining me now, Lyle Fitterer. He is Senior Portfolio Manager at Baird, where he runs Baird Strategic Muni Bond Fund and Baird Muni Bond Fund, Baird Municipal Bond. And while they sound the same, there's one with Strategic Municipal Bond, one just Municipal Bond. It's about the breadth of the funds and some duration decisions. We may get into some of that as well. But if you want to learn about the funds, their differences, and everything else they do at Baird, go to bairdfunds.com. Lyle Fitterer, it's great to have you back on Money Life.
Great to be here, Chuck.
Let's talk first about the bond market broadly, because while the stock market has gotten back to record highs, people have been pretty happy to overlook the bond market, and yet the bond market in general clipping pretty nice coupons right now, and you're doing it without much risk. While the market has been going up, it's not like folks think there's a lot more left to run. So your general take on where the bond market is, especially in light of the Fed not yet cutting rates?
Yeah, I don't think a whole lot has changed relative to where we were at the end of the year. If you think about it, I've just pulled up the 10-year treasury yield, and it's roughly around a 4.4% plus or minus. We started the year, I think, around 4.25. Obviously, we've had a lot of volatility intra-year, but I think what we were telling people at the beginning of the year was, hey, absolute rates look pretty attractive in the fixed income marketplace. You can actually get some yield now. It offers some diversification. Spreads, if you look at it in the corporate sector, how much additional yield are you getting to buy corporates or structured products, actually aren't a lot different today than where they were at the end of the year. We're near long-term lows if you look at corporate spreads, and if you look at high yield spreads. Structured products, similar type of story. Again, had a lot of volatility there, and there were some opportunities maybe to add some risk throughout the period. And then if you look at the muni market, one of the biggest differences is munis have underperformed year to date, primarily, intermediate to longer term munis. There's been a tremendous amount of supply. You had some volatility associated with the tax bill and the potential that the muni exemption was going to go away. But right now, if you look at valuations, long munis are close to 100% of the yield on treasuries. And historically, that's been a pretty good time to buy. So again, our theme would be, just like you said, absolute yields look pretty attractive. You're actually getting a real return relative to where inflation is currently. And if you look at that relative to other asset classes, things look pretty compelling.
How much does that change if and when the Fed cuts rates? And will it take more than one rate cut for that to happen? Because the last time the Fed cut rates, we didn't really get all of the ancillary effects that we expect on rate cuts. And obviously, when you're looking at things like the 10-year treasury, rate cuts don't impact the 10-year treasury. But we didn't really get the full what we expect out of rate cuts. And I'm not sure we're going to get it this time. So when do you think rate cuts are coming, and how broad is the impact going to be?
Yeah, we don't have a huge view in terms of, when's the Fed actually going to cut. I guess we would probably agree with the market, probably sometime this fall. It looks like, I think there's obviously a lot of pressure on the Fed to begin the easing process. But if you look at the data, the economic data has actually been relatively robust, and inflation data, while it hasn't picked up substantially, it's trended slightly higher. And I think a lot of people are still nervous about the potential impacts of tariffs and what's that going to mean on inflation. So one of the things I didn't mention earlier is that the curve has already steepened. So if you look at it, rates have actually come down. Longer term rates, again, are stable to maybe slightly higher, depending on what market you're looking at. So the market is anticipating somewhat of a Fed move by the end of the year, and some of that's priced in. So what do we think would happen? I do think once the Fed starts to ease, you could probably see further steepening actually in the marketplace. But a lot of it, again, is going to be, and I hate to be the old cliche, but data dependent, right? We're going to have to see, what is inflation doing, and are the tariffs going to have an impact on inflation while the economy potentially slows down, which gives the Fed, I guess, the cover to start easing? Or, is inflation going to be relatively muted? And maybe when the Fed starts to ease, you'll actually get long-term rates that'll move down, and the curve's shape will stay relatively unchanged.
I mentioned the two funds. One of the key differences, as I asked you, since you run the funds, about them, is you talked about how one of them makes much more of a duration play and is much more focused on duration, or can be more focused on duration. This is one of those times when it is. In other words, in the muni fund, which is covering the whole market, covering everything, you've got a much longer duration than you do in the strategic municipal bond fund. So why that right now? And, given what we've seen in the yield curve, how long does a move like that, where you're dramatically more focused on the short and intermediate end, normally last?
Yeah. So again, I guess a couple of things to point out. That the duration lever that we can pull in the strategic fund is the last lever that we would pull. As from Baird, we're a big believer that it's very difficult to predict the level and direction of rates. However, we think there are inefficiencies in the muni market that allow you to do that occasionally. I think one of the biggest differences in terms of our strategic fund, maybe relative to some others, is we limit that duration bet relative to the benchmark as well. So this particular fund has a benchmark duration currently of around 4. We limit that bet to being plus or minus 2 years, and 80% of the time we say will be plus or minus a year relative to the benchmark. And actually right now we are about 1 year long. So we're a little over a 5 duration in that particular portfolio. Why As I said earlier, munis relative to treasuries have underperformed. And if you look at where ratios are, especially on the intermediate to longer end of the curve, from a long-term perspective, they look pretty darn attractive. So we've been modestly extending our duration in that portfolio. That being said, the muni bond fund always has a longer duration. Its benchmark duration is the full market muni index. And currently, because of what's happened with rates, that duration is almost out around an 8 on an option adjusted basis. So a couple of difference there. And then the last thing I would point out is even within the strategic fund, we are doing some of what we would be doing in the municipal bond fund, which is trying to add duration exposure on the longer end of the curve, not necessarily 30 years, but more in the, say, 15 to 20-year part of the curve, because we think that's kind of the sweet spot right now. And then finally, I would just say that the other thing we've been doing in both of those funds and across all of our funds is what we would call an up in quality trade. So reducing our exposure to lower quality credits and increasing our exposure to higher quality credits.
As you talk about higher quality credits, what became a big story in the springtime for about a week was when Moody's wound up downgrading U.S. debt. I recognize you are a specialist in muni bonds, and muni bonds different from treasuries, et cetera. But there was a lot of talk about what the fallout would be and what that might do. Have you seen anything that even remotely resembles fallout at this point? Because it is the kind of thing we got to talk about it, but we don't have to. Like, I think the reason it faded after a week was that nobody expected anything. But if it was going to have fallout, would it have it in ways that somebody would be saying, okay, treasuries have been beating munis. I like the structure of treasuries a little bit less, and I like the opportunities in munis more. I mean, is that something that plays out down the line?
I think that is potentially something that could play out down the line. You know, munis really aren't impacted by international investors. They're primarily purchased by U.S. investors. There is a taxable municipal market where international investors will get involved, but it's pretty small. So the driver of performance in municipal bonds is really the U.S. investor. And a big component of that is what do direct individual investors think about the market, the absolute level of rates, their worries about the muni market from a credit perspective. So relative to the treasury market, you don't necessarily have some of the international influences. So what's happened, you know, obviously everybody knows the dollar is weaker. Now, is that related to the fact that the treasury got downgraded? I would argue probably not. So really the impact from our perspective on a treasury downgrade is pretty muted. You know, I think a lot of people said that investors are going to, flee from the U.S. We don't think that's necessarily the case. I think there's still been a lot of interest in U.S. investments, both bonds and equities. You know, if you look at it on the corporate side, we've seen huge demand from international investors for corporate bonds. It's part of the reason why spreads are at or near historical tights within that sector. Why? Because it's really one of the only places from a global perspective where you can get long duration in the marketplace. And there's a big need from a global perspective for long duration. So again, I would just say that the short and quick answer is that the Moody's downgrade has had limited impact going forward. If it does impact the treasury market, probably has less impact on the municipal bond market.
There are folks who believe we will see something of a deregulation trade. We will see certain industries that as they become deregulated, it frees up capital and it makes certain businesses do better. Well, now let's move that over to the bond side of things. What we have seen in the Doge world, in the cutting expenses world, et cetera, is a federal government that wants to put more of what needs to be done onto state governments. And if that's going to happen and it can't pass certain appropriations bills and the rest, it is going to wind up being states that are doing some of the infrastructure spending and the rest. Does that mean that we are about to have some sort of a boom in muni, state bond, et cetera, issuances because states are going to have to pick up the slack? And if so, when does that start to show up?
Very good question. And I think it's actually something we've been thinking about. Two components to that, I guess. One is the federal government going to push more of the burden down to state and local governments? So just in terms of cutting federal support for state and local governments. So that obviously has a credit impact. And you're already starting to see that to a certain degree. And then you also have obviously things like what's going on in Medicare and Medicaid. How's that going to impact state and local governments? You've got the whole talk about FEMA. and the potential that the federal government's going to start paring back on FEMA payments. So what does that mean from disaster relief perspective? Does that have to go down to state and local governments? And state and local governments are coming off of, they pretty much spent all their COVID money. So, if you look at it, we are past peak credit within the muni market. That's point one. Fundamentals still look pretty good. Rainy day funds still look pretty good within the muni market. So we're not calling for a doomsday. But again, I think you have to pay more attention to what's going on by state perspective and also how those states might push down those problems to the local level. So that's point one. The second point that you asked about was basically with state and local government, are they going to have to issue more debt? We've already seen that. If you look at issuance in 2024, you had record issuance, and people are looking for record issuance again in 2025. Year to date, I think we've had right around 320 or 330 billion. I think we're on pace to get to 580 to 600 billion in terms of total issuance. So you are seeing some of that. Now, some of that issuance was accelerated in areas like healthcare and maybe higher education because of some of the concerns surrounding those sectors and the potential that that tax exemption could go away. So that's behind us. But we've been saying this for a long time. The outstanding debt in the muni market really hasn't grown in the last, 15 plus years. So relative to corporates, relative to treasuries, it wouldn't surprise us if you see it grow. And then, as we all know, there's a tremendous amount of what I would refer to as deferred CapEx in the muni market. Drive on a road, drive on a bridge, everything. So that infrastructure spending could definitely lead to more issuance. I think it'll be welcome. I think there's plenty of investors that want to buy it. I think there's plenty of demand for tax exempt investments. But again, you could see supply pick up, and that could keep munis maybe a little bit cheaper than they have been historically.
It will be interesting to see how it plays out. There are a lot of unknown variables, but I'm glad to know that you're looking at them, and I'm really happy that you came and joined us and got a chance to talk with us about them. Lyle, thanks for taking the time to join me on Money Life.
Great to be here. Thanks, Chuck.
Lyle Fitterer is Senior Portfolio Manager at Baird. He runs Baird's Strategic Muni Bond Fund, BSNSX, BSNIX, depending on share classes, and Baird Municipal Bond Fund, BMQIX. Learn more about the firm and its funds at bairdfunds.com. We've got much more to go on this show, including Patrick Healy from Caliber Financial Partners talking stocks in the market call. But up next,
Danger.
we are going to head to the baddest biker bar in the investment world. We're going to the danger zone with Kyle Gusky from New Constructs when Money Life continues right after this message. If you're looking for trouble, belly up to the bar because you've just entered the baddest biker bar in the investment world. Welcome to the Danger Zone. Yes, this is the Danger Zone on Money Life. It's where we get the latest take from the experts at New Constructs, where they bring together discounted cash flow analysis and forensic accounting. They do it, and it helps them deliver evaluations that run on a scale of most attractive to most dangerous. They dig in at the footnotes level and work their way up, and they're looking for situations where the surface level numbers are misleading. If something works in your favor, if it's misleading and would help you, that would make something attractive. But what we tend to focus on here are the ones that would work against you, and those are therefore dangerous. Learn more about how it works by going to newconstructs.com. Kyle Gusky is investment analyst at New Constructs. Kyle, great to have you back on Money Life.
Great to be back. Thanks.
Who's in the danger zone this week?
Sunrun.
Danger.
Sunrun. It's ticker symbol RUN, and this is a company that has been in the danger zone before. In fact, less than a year ago. And I will simply point out that when you put it in the danger zone in September 2024, you pretty much called the market top. I mean, there was a time a couple of years ago, 2023 or whatever, that the stock was trading above like $22. But you put it in the danger zone right at around $22, and it has not even been close to that again. So it's taken a big haircut. What has you putting it back in the danger zone now?
Yeah, the timing on this one was good. It's right around the 52-week high, but then the 52-week low is right around 5, and we're trading back up around 11. So it's been a bit of a roller coaster the past month or so. So we wanted to come out and kind of remind investors that this bump is only making the stock more expensive. As it fell towards 5, it was actually looking, not undervalued by any means, but it was like, hey, this is trending to a closer to the negative economic book value that our model shows. And so when it bounced, doubled in the past month or so, time to revisit it and say, hey, this still looks bad. That's still a company that is highly levered, negative profits, burning cash. So the stock price rebound is not warranted by any of the fundamentals.
Okay. But the story that gets told about Sunrun is not highly levered, negative value, burning cash. The story that gets told is this is a leader in the residential solar installation business. That, like, if you think you might want to add solar panels to your house, there's a good chance you're going to be using Sunrun products, etc. So why is there that disconnect? Because you can't argue the leading position, can you?
No, that is totally accurate. They, say market leader. I think they've got 18% of the residential solar installation volume, is what they report and say, that's the market leader. Nothing we, can't refute that. But what is good for the consumer is not necessarily a good business. Basically, to fund all those solar installations, you've got, debt issuances. They're securitizing a lot of the lease agreements they've got with customers to raise additional debt to then go and deploy to install new systems. So it's a scenario where you got a business that is raising a ton of debt. Total debt has increased from 1.5 billion in 2017 to just under 14 billion in the trailing 12 months ended the first quarter. It's your latest financials. So debt is increasing at an extremely fast clip. Profits remain negative, and then as you increase that debt, you've got increased interest expenses. So the free cash flow on the business has been negative in every year of our model. It was negative 2.5 billion over the trailing 12 months. And since 2018, they've actually burned through over 16 billion in cash. So you've got a highly cash burning business. Might be great for consumers, might take a lot of market share, but on the profit side and the actual operation of the business, it is not looking good.
That cash burn, we may have buried the lead here because Sunrun has been on your zombie stock list for more than 2 years. Interesting thing about the zombie stock list that you guys put together. Zombie stocks are stocks where you see them running out of money within 2 years. Like I said, this has been more than 2 years, almost 3 years since it went on the zombie stock list. It is still a zombie stock. How close are we to running out of money? And does that have something to do with your timing of this pick right now?
Yeah, so the zombie stock is definitely an issue here. When we first talked about it as the zombie stock, I think they had less than 1 month of cash. And the caveat with any zombie stock is they can prolong that runway as long as they can issue shares or raise debt. Just in 2015, Sunrun has priced 3 different securitizations to help raise debt. So that is extending their runway. And we see that continuing because as of the 1Q25 financials, they basically had 3 months of cash in March, which would imply, less than 1 month now, which makes sense given their high cash burn. But they're able to keep going because of that debt, which is why we wanted to raise some alarms here of the debt issuances aren't going away. It's going to become a more increasingly levered company. And as that debt level increases, again, interest expenses rise. Cash isn't there to even pay that off as it is, burning cash. So a scenario where it's just going to become increasingly levered and without any change to the operation of the actual business model, which is, financing these things, selling off the debt, taking outside capital to really install them. There doesn't look to be an avenue where that's going to change and turn this company immediately profitable.
And priced in the $10 a share range, you've already said it has a negative economic book value. Priced in the $10 a share range, how out of whack is the valuation? Because you've already said as well that the revenues aren't growing.
Yeah, we start with the economic book value, which is a astonishing negative $83 a share. And that is, the no growth value. And it's based on, they've got billions in debt, 1.5 billion minority interests, some deferred tax liabilities, a little bit of a couple million in outstanding employee stock option liabilities. So a lot of liabilities that go into that negative 83 a share economic book value. So we can look at it and say, let's give them credit. They can keep growing a little bit, much faster than they've been growing in the past. Margins can improve. They've got a little bit of ability to monetize some of the investment tax credits. Debt costs might get cheaper, help out the margins, stuff like that. And we can put together a reverse DCF scenario to figure out what is baked into that $10, $11 share price. And essentially, our model shows that in order to justify the current price, they'd have to increase margins to 12%. Right now, they're negative 24%, and then grow revenue 32% compounded annually for the next decade. That revenue growth rate is 2.5 times the projected solar market growth rate, and implies that they're basically going to grow revenue to almost 34 billion and profits NOPAT to over 4 billion. Again, revenue right now, 2 billion, profits completely negative. So huge expectations in the current price, just to justify that $11 a share. Anything less than that is all downside risk.
That said, the thing that you can never guess at is stupid money risk, because stupid money risk is somebody coming in and buying something or bailing it out or what have you because they like the franchise. And that leading position that we talked about, at least in my mind, makes these guys a super candidate for stupid money risk, doesn't it?
Could be. They could also be a candidate to pick up out of bankruptcy if they run out of cash. But stupid money risk, by the name, implies the stupidity part of it. We've seen, years ago, Solar City was saved by Tesla. There's some recent deals with Tesla and Sunrun in Texas. Stupid money risk could come from something like that, where a different type of company, adds on to their market position. But from, the no growth value, economic book value, high expensive stock price, this one would be better to let it run its course, the cash burn on the company, and then pick up the pieces and, take the market after that.
It's Sunrun, ticker symbol RUN, a zombie stock with a negative economic book value of $83 a share. And it is back in the danger zone, and deservedly so. Kyle Gusky, always great. Thanks so much for joining me to talk about it.
Thanks for having me.
Kyle Gusky is investment analyst at New Constructs. And again, if you want to learn more about what they do, how they evaluate securities, see the most attractive and most dangerous list and more, find out all the zombie stocks, go to newconstructs.com. We are heading for home on the Monday, July 28th edition of Money Life. Up next, Patrick Healy from Caliber Financial. He'll be here talking stocks in the market call when Money Life returns in just a moment.
Oh, wow. This is actually pretty dangerous.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Patrick Healy, founder and president at Caliber Financial Partners, is here. We're talking stocks, and it's time for the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. Returning to the Market Call today, Patrick Healy, founder and president at Caliber Financial Partners. And if you know the name, you can find it online because their website is caliberfinancialpartners.com. Patrick Healy, it's great to have you back on Money Life.
Great to be with you again, Chuck.
We always start with methodology. You've been doing this for a while. You got a methodology that you like to stick to. Explain how it works.
Sure. Well, I've been on your show several times, and, historically, I will kind of preach a barbell approach to portfolio allocation. One end of the barbell being growth or, higher risk on names, and then the opposite end of the barbell being more income or cash flow oriented names. I had to modify that, over the last couple of years, because what I'm finding are that clients are really terrified of volatility, and the reaction that they have puts a lot of pressure on me as a money manager. And in an effort to kind of smooth out returns, what I'm doing is more dynamic rebalancing now, where, I still want to be growth and risk on, especially in this environment. But as I'm hitting price targets and peeling back some profit, I'm kind of reallocating some of that to the opposite end of the barbell. Not staying away from growth, but, kind of transitioning as we get through the cycle. And that seems to be working well for me.
It's interesting because, of course, everyone looks at this year and says this year has been super volatile, but we've just been through a stretch where we went, 3+ weeks where we didn't have a 1% day on the market, and we've just been climbing that wall of worry. How much is that dynamic rebalancing strategy basically forcing you to play defense? And how much do you have to push people to go, yeah, I understand that you don't like volatility, but volatility and risk are not the same thing?
Yeah, so I mean, I don't know if a lot of retail investors really differentiate the two, right? I mean, volatility to the downside is the scariest thing that they can experience. On the upside, they don't care, right? I mean, you're making money, there's no care in the world. But as you pointed out a minute ago, we've really kind of climbed that wall of worry. The market's having a much different reaction to some of the tariff threats than they did back in April, where the market just tanked. And so I think they've kind of discounted, the administration's negotiating tactics and, starting to see trade deals get announced. I think that's alleviating fears. But we're also getting later in the year where the expectations of interest rates coming down are growing. And so I think that's generally a bullish atmosphere for stocks and risk assets. And so, nobody's complaining in this environment, but back in April, there were some worried people.
With that, how did you respond in April? Because it's a dangerous time to be responding when folks are nervous and folks are fearful and the market is tanking. Dynamic rebalancing sounds great, but if an individual investor was doing that, it's called bad timing.
Yeah. So, I didn't do a lot of dynamic rebalancing in that environment, right? Because there weren't a lot of profits to peel back. It was more hand holding people through. And fortunately, the market bounced back rather quickly when he extended the deadlines on sort of the tariffs being put into place. Those extensions have happened several times, but it seems like we're getting more clarity around some of the big trade deals with some of our trade partners. I think Japan was announced earlier this week or last week, and it sounds like the EU is getting closer to a deal with the US, which would be terrific. And so I just think the market's reacting differently, and they've kind of shrugged off sort of the Trump administration's approach to negotiating.
So let's talk about this market now. In this environment where we've seen so much uncertainty, but we've watched the market climb the wall of worry to get back to record highs, what has appealed to you?
Yeah, so the AI trade, not surprisingly, has been, the darling of the market. And I continue to think that that's going to be the case just based off the amount of dollars being allocated to that space and the data center build out, the power infrastructure in our country and really around the globe. And so it's garnering so much attention because of the, hundreds of billions of dollars that the Mag 7 and even, certain sovereign nations are spending to kind of facilitate that industry and growth. So that's going to remain strong. I think since the last time we spoke, we've gotten some substantive crypto legislation, which is really putting some tailwinds behind that industry. I'm very bullish there, even though historically that's been one of the more volatile sectors. I think it's gaining traction and really getting institutional dollars. So try to follow the money in terms of developing, investment themes. And that's where a lot of the money is being allocated. And so I think that will continue for the foreseeable future.
When it comes to AI, is it the big names that have been drawing the headlines, or are you trying to find where we're going to get more breadth and maybe get what's next?
Yeah, great question. So I do think that the big names like NVIDIA are going to continue to garner a lot of attention. It's a safer name for institutional investors, but a lot of these startups in the AI space are probably private companies today. I do think the IPO markets are starting to open up again as interest rate expectations are coming down and the capital markets are growing stronger. You're starting to see a little bit of tick up in M&A activity. But I think a lot of the sort of emerging startups in AI are still private companies. So difficult to tap into that as your average investor today.
Beyond AI, what stands out to you right now?
So I've always been a big follower of the commercial real estate space, and that's been kind of a laggard, not surprisingly, with interest rates being so high. But if we do get some rate cuts later in the year and into 2026, I think across the board, commercial real estate should do better. Again, as interest rates come down, those valuations prop up. Not surprisingly, just kind of building on the theme I just mentioned, the data center REITs are hugely popular. The industrial REITs continue to be strong just because of the amount of e-commerce in our nation. So I do think that that space will benefit from rate cuts, and that might be on the sort of the left side of the barbell, the one that's generating income and a little bit safer play. But I do think you need to be allocated across multiple sectors just to kind of balance out your risk profile.
So let's talk a little bit about brass tacks. Is there a name in those spaces that stands out to you as kind of the poster child for what you want in terms of, what you're looking for in balance sheets and the rest?
Yeah, so on the real estate side, Digital Realty is a good name. I think Iron Mountain are both sort of either in the data center play or industrial or some hybrid of the two. I think those are two names that have traded very well and been resilient despite the rates being high, and I think they'll continue to do well as rates start to come down.
On the AI side, you talked about liking the NVIDIAs of the world. Are there ancillary plays? Are there companies you think are going to wind up benefiting that maybe aren't as obvious?
Yeah, so some of the smaller semiconductor names, NVIDIA has been, obviously the 800-pound gorilla in the room, and they have such a head start with their tech, but they have limited bandwidth, and there's so much demand for chips that you're going to need other players to step into space. So a small cap name might be American Semiconductors. Has really traded well over the last couple of months, and that's a name to maybe take a look at on a more speculative play.
What makes you sell once you've got these names, other than the dynamic rebalancing, which is really about position sizing and trying to, offset some gains and some losses, things along those lines. But what makes you, when you found a company that you like, say, okay, I don't like it so much anymore?
Yeah, great question. So, if their business model changes, or if, for example, they're in an industry like biotech or pharma and they have a drug failure and their entire future is linked to that one drug development, it's going to be dead money for a long time. So that's an example where I might sell. If a company gets too weighed into the political environment, I tend to get, spooked by that, whether it's Elon getting involved in, politics in Washington, or if you start to see companies kind of, putting their thumb on the scale. I generally don't like that. I think they should rely on the business that they're in and stay out of the political arena, because they're playing with fire, especially with this administration, I think.
I want to ask you about a stock that's been in the news for different reasons. It's actually not a stock; it's a company, and it was not a tradable thing. But everybody's seen the whole Coldplay thing with the Coldplay concert, where the CEO of astronomy winds up being caught in compromising photos with his head of HR, et cetera. Now, astronomy is not a publicly held company, but I'm curious if that had been a publicly held company and it was in your portfolio, how would you have responded as a shareholder? Like, here it is going, okay, but this doesn't affect our fundamentals. It doesn't do whatever. It might impact whether management is sticking around. Aside from getting to laugh at memes and things along those lines, how would you react?
Yeah, this is a great question. So I think you're gonna have to make a distinction between a private and a public company in this context. And what I mean by that is, if you're publicly traded, you're likely a more mature company and you have a deeper bench, and your board may be able to replace the CEO a little bit easier. But when you're in a startup in a private company and you're relying on growth capital to fuel your expansion plans and whatever your business model is, I don't think you have the luxury of doing that. And so in many of those situations, the founder or the CEO is so linked to the success of the business that when you have a scandal like this, you really kind of have to clean house. And to his credit, he stepped down. I don't want to give him credit for too much. And I believe the head of HR also stepped down this week, or was shown the door. And so, it's embarrassing. And I think they both had to go under the circumstances if they have any chance of survival and being able to tap the capital markets.
See, it's interesting to me because I could also see the capital markets saying, and not in a sexist way, not treating them differently, but if he's the CEO and the founder and any of this is intellectual property and whatever, was he the brains behind the operation that made it that this company got their money in the first place? So I can see it both ways as an investor, not looking at any of the stuff that was on the Jumbotron, just as an investor going either way. And again, yeah, it would be very different if it was a public company, wouldn't it?
Chuck, if I can, ask yourself, if this ever happened to Sam Altman, the head of OpenAI, would the market react differently, and would they treat him differently? Because he was very coveted when he was initially going to separate from there, and Microsoft was ready to scoop him up. And so I do think it's a case by case, and they're obviously a more established, higher demand company. But I don't know if the market would have had the same reaction to the company had it happened to someone that high profile. So, interesting.
It sure is. And now we're going to get your take on some stocks that my audience is particularly interested in.
Quick and dirty.
Always account for variable change.
Well, yeah, we have been talking about how variables are changing, maybe in ways that we weren't even expecting here, with Patrick Healy. He is the founder and president at Caliber Financial Partners. He's been talking about how he's been accounting for variable changes in this market. If you want to learn more about what he's been doing and how the firm works, go to caliberfinancialpartners.com. Quick and Dirty is our lightning round, and a little reminder here that Patrick is giving his opinions, but they are his opinions. They don't reflect necessarily investment advice. And he wants you to be reminded that seek out a financial professional before you're making investment decisions on anything you hear on this show or any show. He's not actually just saying it about this show. It applies to all shows. We're going to start with the request we got from Amy in San Diego for, I think it's pronounced Ionic, even though it's spelled IONQ. It's Ionic Quantum Computing, and the ticker is IONQ.
Yeah, so INQ is how it's pronounced, and I know the company well. And full disclosure, I am invested in this company. I have some clients allocated as well. Big quantum computer stock. That subsector has really traded terrifically over the last 12 months. And I think INQ is one of the leaders in that space. They're former SPAC, so they were de-SPACed, I think, in 2021. They have a new CEO who came over from private equity, Niccolo Damasi, who I have a lot of respect for, really sharp guy. And they've acquired a number of companies in the last 12 months that I think they're really kind of, expanding and building out their empire. So I do like this name. I think it's something you can hold long-term. The valuation's a little stretched, and it's a highly volatile, subsector. But long term, I think this is a game changer, and this is something obviously I own personally.
And so, with that warning about being a little bit stretched in terms of pricing, meaning you might want to wait for a pullback.
I'm in this for the long haul.
Still, a long-term buy on IonQ, IONQ, IonQ Quantum Computing. Our next request comes from Sam in Woodbridge, Virginia. He wants to know about Cirrus Logic. It's CRUS.
Right. So Cirrus Logic, I believe, is a semiconductor company. They make parts for iPhones, and the stock has not really sort of traded sideways over the last 12 months. And I think some of that is a function of fears around tariffs, because some of their production is made in China and what the numbers were going to look like. And not surprisingly, Apple has kind of underperformed in terms of the Mac 7s, and Cirrus is a component part in Apple iPhones. So this is probably a name I would avoid. I think it's a value trap, and there are better places to allocate capital for the next 12 months.
Maybe it's time to sell this.
Yeah, that's a sell or an avoid on CRUS, Cirrus Logic. Mark in Eagan, Minnesota gets the next request. It's for ASTS. That's AST Space Mobile.
Yeah, so this is also a former SPAC. It's a satellite company, so they launch satellites up in orbit, and this has traded incredibly well over the last 12 months. I think it's up 200 and something percent. And interesting company, dynamic sector, could be innovative and breakthrough. I would probably either hold off on this or wait for a pullback just on valuation alone. It's trading near 19 billion in market cap, and they haven't even generated profits yet. So, we are in a risk-on environment, especially as rates come down. And so if you get a pullback in this name and you're a long-term investor, that might, provide a good entry point. But at these levels, I'd probably hold off.
Hold, fire!
Yeah, if you haven't taken your shot already, you're waiting for a better valuation and a better time to take your shot on ASTS, AST Space Mobile. That was a hold to a buy at a better price. Our last two requests today come from Richard in Chula Vista, California. The first is for DocuSign, DOCU.
Well, great, Richard. DocuSign is obviously an electronic document service. We use it every single day, sending paperwork out to clients. It's been a game changer for our business. It's kind of replaced some of the UPS and FedEx envelopes that go out with paperwork. So much more efficient, makes our business cut costs, and turnaround times are improved. So I do like this name. I think it's a reasonable valuation, like a 15 PE. which is below the current, average market PE. I think this will grow in popularity. I think this will benefit from the AI craze as well. So this is something I would certainly consider adding.
Buy it outright.
That's a buy on DOCU, DocuSign. And Richard's other request, our last one for the day, American Express, AXP.
Yeah, so I am a American Express card member personally, and obviously they're a company that's been around for a storied history. I think just with the recent crypto legislation, the Genius Act passing, and the emergence of stablecoins, I think it's going to cannibalize some of the traditional payment system and remove some of the intermediaries, and names like American Express, MasterCard, Visa may have their businesses challenged. And so just given that uncertainty and not knowing how quickly that comes online, I'd probably avoid this name.
And so we finish on a sour note. That was a sell or an avoid on American Express, AXP.
Oh boy, that sounded bad.
Well, it sounded bad on American Express, but what sounded great was Patrick Healy here on Money Life. Patrick, always great to chat with you. Thanks for taking the time. We'll do this again down the line.
Sounds good, Chuck. Enjoy the rest of your summer.
Patrick Healy is founder and president at Caliber Financial Partners. If you know the name of the firm, you can find him and the firm online because it's caliberfinancialpartners.com. We're almost done with the Monday show here on Money Life, but that means you want to know what's coming the rest of the week. Well, I will tell you where Patrick agreed or disagreed with some recent guests, and I'll lay out what's coming for the rest of the week if you just stick with me till the end. We also got a contest to announce in just a second, too.
To navigate today's complex market, investors need accessible, quality research. Vetify offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
We are back to wrap things up, but we got a lot to do before we get there, starting with just a little bit of crossover we had in that interview with Patrick Healy. He talked about Iron Mountain. He mentioned DLR, Digital Realty, and Iron Mountain as the two things that were the first poster children. Greg Halter, Director of Research at Carnegie Investment Council, had Iron Mountain as a hold back on March the 27th. He said he might buy it on dips. It was about $85 then. Fell by almost $10 after Liberation Day, but it's now trading over 100, so not really much dips to do there. And then during Quick and Dirty, you had American Express. It was a buy today. Francisco Beto from FM Acceleration had it as a buy on April the 24th. He said it had a 50% upside. It was trading at about 260 then. It is now at around 310. So a 50% upside would have been up to 390. So presumably there's still upside there. There is much more upside to go on the show this week. How about guests like Frank Holmes, Chief Executive and Chief Investment Officer at U.S. Global Investors, Paul Grunwald, Chief Economist from S&P Global Ratings, Scott Ladner, Chief Investment Officer at Horizon Investments, David Miller, the co-founder of the Catalyst Mutual Funds, Matt Harris, Chief Investment Officer at the Hausberg Group, and more. But we also had a contest that I'm sure you're waiting for us to tell you about, and it is time to let you know the winners of our contest. We had two authors on the show last week. We ran a combined contest to give people a chance to win their books. First, it was The Almightier, How Money Became God, Greed Became Virtue, and Debt Became Sin by Paul Vigna. And then we had The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life by Nick Majuli. Since the contest involved The Almightier and a ladder, the contest that Rob Floyd, our executive producer and contest master, came up with was about when the boys on South Park built a ladder to heaven, a famous episode from season 6. And in that episode, the boys are trying to get to heaven to see their friend Kenny, who has died again. To be entered for The Almightier, you had to tell us what the boys were trying to get from Kenny that prompted them to build a ladder to heaven. And by the way, they were looking for the winning ticket that Kenny was holding. And then to be entered for the wealth ladder, you had to tell us what the boys would get if they found the item. So they found the winning ticket, and what they were holding the winning ticket to was an all-you-can-grab candy prize. Almost everybody got their answers right. We then did a drawing for the appropriate folks, and our winners are, for The Almightier, Kent in San Carlos, California, and Ned in Green Bay, Wisconsin. For The Wealth Ladder, Bill in Ellicott, Maryland, and Pete in Bothell, Washington. Thank you for entering, guys. We will get those off to you as soon as we can. Meanwhile, if you're looking for something to celebrate, it is National Water Park Day. It's also National Soccer Day. It's also National Hamburger Day.
I'd gladly pay you Tuesday for a hamburger today.
And National Milk Chocolate Day.
Chocolate.
Who can't celebrate those two? Let's celebrate my guests for a moment. They were Selma Hepp, Chief Economist at Cotality, Chairperson for the National Association for Business Economics Business Conditions Survey, NABE.com. Lyle Fitterer, Senior Portfolio Manager for Baird, BairdFunds.com. Kyle Gusky, Investment Analyst at New Constructs, online at newconstructs.com. And Patrick Healy from Caliber Financial Partners, caliberfinancialpartners.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Arvind Swamy, who said, "For me, whatever I do, I believe I must do it seriously and invest a lot of time to understand and learn." Well, when it comes to investing, yes, you want to invest your time. You want to take it seriously because it has a lot to your future, but you also want to keep things in perspective. So remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Shut up, fool!